Welcome to the Hey Docs podcast with your host, Jill Allen. Today, I am welcoming back Steve Steinbrunner from Provide. Steve works closely with orthodontists across the country, helping them navigate financing decisions during some of the most critical moments of practice ownership. From startups exploring commercial real estate to buyers evaluating practices with declining revenue, Steve has a clear view into how lenders are thinking right now. In this episode, we're breaking down what banks are actually supporting, how doctors can prepare for loan requests, and where aspiring owners often get tripped up. So let's jump in. This episode was brought to you by Gray Finch. Hey docs, if you want to have a great business, the right practice management software is essential. But some can be slow, outdated, and lacking good support. That's why I recommend Gray Finch to all orthodontists. It's the fastest, most reliable, and most secure platform to grow your business and improve your efficiency. It's completely web-based, so you can run your entire practice anywhere and from any device with no servers, no downloads, or hidden fees. They even have the most helpful and responsive support team around. Right now, Gray Finch is giving a $500 discount to our listeners. Visit grayfinch.com/Jill Allen to learn more and see why it's one of the fastest growing providers in America. Steve, I'm so excited to have you back on Hey Docs. Thanks for being here today.
Of course. Yeah, it's my pleasure. Thanks for having me back.
Absolutely. So, in the event that somebody has not caught one of our other episodes together, can you just give us a quick refresher on who you are, what's your role at Provide, and what type of orthodontic clients you work best with?
Sure. Yep. Thank you. So, Steve Steinbrunner, I'm technically the regional director of practice finance for Provide, a company that's owned and powered by Fifth Third Bank out of Cincinnati, Ohio. And what I really do is work very closely with independent dentists, orthodontists, physicians, optometrists, independent healthcare practice owners that might need financing for their business in some way. And so the easiest way to think of it is I'll work with them from the beginning. That might be a startup or an acquisition loan to buy a practice or start one off from scratch. But then they might have to refinance that loan or buy a second practice. Maybe they want to buy commercial real estate later in their career. And as a retiring or preparing to exit orthodontist, we can help them prepare to have another emerging younger practitioner buy in. So it's across their whole career. They're going to have kind of business loan questions and need help around that kind of stuff.
Yeah, and I love it. I think we've got such a good working relationship with you and with the bank, and there you are definitely a group out there that just does a lot and really helps our startup and acquisition docs for sure. So thank you for all that you're doing and for getting my docs approved. That's what I need.
Yeah, I mean it's to that point, Jill. It boils down what we really get up for is to help kind of the entrepreneurial young.
Mhm.
Whether it's a dentist or a physician, they don't have a lot of business training in school.
Yeah.
As their clinical training is very sound. So they rely on folks like me as a lender and you as an advisor consultant or a realtor or whoever
Yep.
else to kind of help them get there. So it takes a team.
Yeah, it does. It does. So you and I have both been in this industry for a while. We've talked about a lot of different things on, the episodes that we've done in the past. And today I want to talk a little bit about what you're seeing, what I'm seeing, and just kind of this, I'm going to say this fire or push or interest in a lot of the startup docs pushing to do commercial real estate with their practices. Because I definitely feel like I'm coming up on 20 years now here in, doing my own business and consulting. And I will definitely say this was not a big trend 20 years ago. I would say in the last 5 years, especially, we've started to see more of an uptake with this. And I'm wondering if you can talk a little bit about what you think is driving that trend and how you as lenders are responding to this, because it is a very different thing than just, hey, we're going to do a startup loan, kind of that bread and butter approach that we have taken in the past. So what are your thoughts on that?
Great question. I've got a lot of thoughts on that. So I think before we talk about what we're seeing today, let's kind of set the landscape. So traditionally, healthcare startup loans are mostly financed by conventional practice-based lenders like me. And there's a lot of other banks like me that offer those loans. Those loans tend to be amortized on a shorter schedule than commercial real estate, 10, 15 years, and they can be upwards to $1 million. And the conventional lenders generally will lend those to doctors that are going into a lease space, 2,000 to 3,000 square feet. And those loan dollars are used primarily for the construction and equipment. And that's our loan. And that's the risk that practice-based lenders are really comfortable with. For a startup practice, you're not going to see large conventional real estate loans offered for those startups. And so to your point, Jill, historically, you just haven't seen a lot of it. Occasionally, there can be a startup loan that is financed conventionally, but what you'll see behind that is probably a small real estate loan in a rural area. So if it's a $500,000 building that used to be a house and they need another $400,000 to build the inside out for a nice little dental practice, maybe. Okay.
Yeah.
So for smaller real estate opportunities for startups, it's definitely a possibility. But most of the real estate opportunities for these startups and the locations they desire are not affordable. So we've set the playing field. Now, having said that, you have doctors that are entrepreneurs being connected by sophisticated real estate advisors, probably more today than they ever have been. So the conversation about, well, have you thought about owning, might be coming up more often than not. And the benefits of that are coming up. Because in a lease space, that startup doctor may invest $500,000 this year in that construction inside that facility that they do not own. And 5 years later, maybe their lease comes up, they have a chance to relocate and move away without those dollars. And they do it all over again. So that scenario is starting to become challenging for a lot of these young doctors that say, I want to own real estate now. There's tax benefits to it. There's cost segregation, tax benefits, very little known conversation that any real estate owner should really look into. So there's benefits of owning that real estate immediately, but there's barriers to it from the banks. So options for that, and part of my role is to figure out what tools are available to help them do that. And so maybe it's a different loan. Maybe it's an SBA loan. So we can offer conventional and SBA government-backed SBA 7A loans. That may be a good opportunity to help them do real estate. So now that program may only require, say, a 10% cash injection. And that's changed. The SBA SOP reinstituted a 10% mandatory injection for startups this last year. And it used to be even less, Joe. So I've seen 3% injection on a startup historically, which really enabled some of these younger doctors to get into it because the loan is, even though a larger loan, is amortized over a longer period of time so they can make that lower payment. And if they have enough cash, cash is always king. You can purchase commercial real estate with a startup. So every situation's different. But the challenge is finding the right lender and advisor that can help you determine how do we structure the financing around this.
Right. Well, and I think it's so interesting because, as you and I have been doing this for a long time, to even use the word SBA with the startup is just so, that has not been the common, or, or that would be, a type of a loan that we may use if a doctor's really struggling to get a commercial with a startup. And so I think what I just want to make sure that docs take away from what you just said is we're talking about two different loans. One that's still that conventional, that's going to go, with Provide or, another bank, and then bringing in an SBA loan on that real estate. And that's just such a new, I know it's not a new concept, but it's just something that is newer to what we have been doing. And I think it's so interesting to me, the point that you just brought up about, what our construction costs are costing right now. You and I both know, pre-COVID, the banks weren't even handing out loans for, we were pushing it if we were over 550, 600,000. And if our construction was coming in 300, 350, we were all kind of like, oh my gosh, and now, when we look at where construction is at, and where just in general, how long it's taken for the banks to, for you guys to be able to raise that ceiling and say, gosh, we can't do a startup at 600,000 anymore. That's almost the entire cost of the project just in construction. So I think it's just really interesting to think about a 10-year lease, a build out that's now costing a minimum of, 5 to 600,000, depending upon the area of that loan. Most docs are not going to want to move. It's going to be really hard to move at 5 years, let alone at 10 years. And so if you've got that opportunity and go, gosh, I don't know if we can find a way to have our own property that's associated with this and have that real estate. Now we may be office poor for a couple of years, but we've got equity and a lot of tax benefits that come along with that as the practice is growing, versus paying all that money out to a landlord if for nothing at the end of 10 years.
Well, to your point, if we go into a lease space with a conventional orthodontic loan, say it's $1 million, it's an $11,000 payment per month, and you still have to pay rent. What if rent's $7,000? I'm seeing $10,000 a month all in first year. An orthodontic startup, so you're at $20,000. Well, what if you could purchase real estate, have more money for construction and working capital, and for your consulting, and we amortize that over a longer period of time? So it doesn't become being fearful of a $2 million loan versus a $1 million loan. It's about cash flow. Because your payments may be less or equal to what you would pay leasing in an expensive construction startup versus buying a piece of real estate. So it's you really have to kind of have an advisor walk you through this mathematically and look at all the benefits over a 5 to 10 year period, because these SBA loans are not necessarily for your life. They often have a 3-year prepayment penalty, so that, a couple of years after you've opened your doors, you now have the opportunity to reevaluate. Do I stay in it? Do I want a conventional loan? Do I refinance with another lender? There's flexibility here. And so it now becomes more of a bridge. Or a solution to get the young doctor over the first couple years, if they're sure they're in the right location and they want to buy a building or build ground up. And Jill, they don't have to occupy the entire space. So as long as they're within occupying the required amount, whether it's a convention or an SBA loan, they might have a tenant in the other half of the building where they can have rent coming in from. So lots of opportunities here.
Yeah, for sure. And I love it that we can actually have conversations about this now. I think that we're just being so much more creative than we used to be. And not that it wasn't there before, but I think just with how things have changed, our lending opportunities have changed. I definitely think it's a much easier, in the right circumstance, opportunity for doctors to at least consider it and say, this could be an option. So I want to switch gears a little bit. And now I want to talk a little bit about existing practices and, a doctor that has an opportunity to purchase. So like, instead of doing a startup, they have this opportunity to do an acquisition or to purchase an existing practice. But you and I both know, for a long time, that also has been a really hard loan sometimes, to get behind, especially if the practice has been declining. And it's kind of a double-edged sword, because I look at it from a consulting standpoint and say, heck yeah, if we can get in where we know that there's maybe not value in the AR, but we can see that there's value in the name, value in the area, value in the build out, of this existing practice, the value of, patients that are already in the practice, but the AR has been declining. For a long time, that's been a really tough thing, I think, for us to get banks to get behind it. I'm wondering if you can talk about what that looks like now. What are you guys looking at, to see if it makes sense for a doctor to, to maybe jump on a declining practice that has potential?
Right. That's a great question. So I think historically, the banks you may be talking about look at this, it's more black and white.
Mm-hmm.
It's really just a revenue year over year. It's declining. We're nervous about it. You don't want to buy this, and we don't have faith in that business. I think the mistake that's made there is there's not a conversation being had.
Yeah.
And there needs to be real people that say, what's going on here? Maybe I talk to the owner. Maybe we find out what that story is, because these are not necessarily poor acquisition targets. It could be just a practice that's declining because the owner's slowing down. So is it just a time issue where they've gone from X days to 2 days and mathematically it's right-sized itself, but inherently there's nothing wrong with the practice? Every practice has a story.
Mm.
And so I think you have to find out what's the situation. And if we find one like that, to your point, that has goodwill that we like, brand, community brand that we like, built out, construction, we have an opportunity to look at that for what we call a jumpstart loan. And that's exactly what this is a practice that's declining, but it's not for the wrong reasons, right? And so if the buyer appropriately wants to buy that practice, we might price something like that to cap around 400,000, Jill, and then leave an extra couple $100,000 for additional equipment, maybe a little bit of paint, carpet, consulting.
Yes.
And
yes.
so now we've structured it. And the reason we can do it is we've underwritten that without the cash flow. We underwrite it the same way we do a startup.
Yep.
With our own projections. And so it makes sense for us now because we have a viable buyer who's not borrowing any more than we would loan for a traditional startup from scratch. With you behind them, we would gladly loan to them. And that's called a jumpstart loan.
Yeah.
It would be for an acquisition that's starting to decline. So I would encourage buyers and brokers to remember that there's lenders out there that like those.
Yeah. And I do love that. And I love that you guys are now doing that, because that has always been, I think, the trickiest part is, in the past, things have fit into these little boxes that are hard boxes, and it either works or it doesn't work. And the hard part is, a doc, there's so much goodwill. We pull the demographics. We know there's still growth to be had. We know that, that this practice needs to get off the ground, needs lift, but there's also cash that we need to get that lift. We need, maybe to redo the website. We need to get some branding, just have a little bit of cash for branding. We need to put this is going to be awful, but a little lipstick on the pig, right? Like, we need to bring it from, circa 80s to, early 2000s, and sometimes it is amazing what a little fresh paint, what a little, let's get the old, shag carpet out and let's get some, plank flooring in. I mean, it doesn't take a lot to give that little lift to then really help that doctor coming in just take things and just go and grow. And so I just want to say again, I really love the idea of this Jumpstart program, because in the past, what we would have to do for any docs that are listening is, a lot of times, if we could get, the banks to loan for us, we may have to then go and, try and secure, some type of a loan, like help me out, Steve,
Like a line of credit or something.
yeah, a line of credit to be able to do some of this, or doctors were pulling from their home equity, or crazy things like that none of us advise, but we've had to do in the past. So I think it's exciting to hear that, especially with Provide, you guys are being very, I think, proactive in meeting customers where they're at and where the needs of our industry is right now, and not taking such a black and white approach. So
Yeah.
I'm super excited about that.
You bet.
So let's talk a little bit about docs who are getting ready to do a loan, whatever that loan may be. Could be an acquisition, could be a startup, could be whatever. What do you think are the most important things that they need to do right now to put themselves into a strong position for you guys?
Financially, kind of get your house in order.
Mm-hmm.
And that involves a couple different things. Cash is king. I said it earlier. And what that means is I want you to afford cash.
Mm-hmm.
And that is defined as non-retirement. You're going to hear the banks call that liquidity.
Mm-hmm.
That is things like checking and savings accounts, even securities or stock that you might trade in a brokerage account that can be liquidated very quickly in the event your practice is on fire. That's the way you think about it.
Yeah.
Banks want to look at what do you have available to you if you get in trouble. And if you have no money in the bank, today it's going to be a little bit more difficult. So, try and target 10% of what you want to borrow. Doesn't always have to be that, but that's a really good safe number. So save money. Also be diligent about what purchases you make early.
Mm.
Can you wait on the big house or the big car? And if you have income to support those, I'm the first one to tell you, knock yourself out. But understand you'll have to buy a larger practice to be able to accommodate your lifestyle and cash flow.
Mm-hmm.
So if you can put some of that stuff off, do. We're fortunate that when people purchase a practice with us, we have a mortgage partner in our division that we can use that practice cash flow to help them immediately get a mortgage. Or a lot of lenders will say, oh, you got to wait a while. We want to see that practice performance over a year. So we can actually do them immediately. We've done a practice sale and I'm closed on the mortgage the next day. So preparing for that, having conversations about what you want to purchase personally with your lender probably makes sense. Third thing would be build your team now. Find an advisor like you that understands the inner working of that practice. Find a healthcare specific realtor. Just start determining what would rent be in this area that I want to be in. I've seen doctors go all the way down that road to where they're going to make an offer on a space before they call a lender and find out that the rent's $13,000 a month the first year, and nobody's going to approve that.
Yeah.
So have those conversations early. Have conversations with your builder, your contractors, your designers. You can find those dentist specific people in your market. It's not hard to find out who the good ones are and start to shape out a budget. So when you do talk to your lender, you're educated. Hey, I'm told that my construction might cost this in that area. I think my rent's going to be about $9,000 a month. That's very helpful in helping us determine what's possible for them.
Yeah. Yeah. That's great. And to the point of the cash, I mean, I think that I have so many docs that'll be like, oh, Jill, I've got, this tied up in this, and I've got this investment, and I've got these, 3 properties that I own, and, blah, blah, blah. But to your point, for the loans that we're looking at doing, if there is a way to have that, that cash sitting there, that's really, what you do after that practice, that's a whole nother thing. But when we're looking at the purchase or the startup, having that liquidity is really what we have to be searching
really
for.
Key. And congratulations on those folks that own investment properties. That's not considered liquidity. I can't count the value of that.
Yeah.
And then, maybe there's other ways we can develop lack of liquidity with gifting from friends and family members or other guarantors who can bring income and liquidity to the loan. So sometimes adding a spouse to a loan request just as a guarantor, they're not actually a borrower on the loan, but their income and liquidity, it enables us to use it in the cash flow.
Yeah.
And so we can sometimes overcome that with other people around you that might be able to help shore up that cash savings.
Yeah. And I think that's what I love so much about, working with you, Steve, is I think, you really do take it as a, kind of a holistic approach. And it isn't just about checking the boxes to see if, the clients qualify, but really giving them a plan, even if right now they're not going to do it, just giving them something to think about to be able to plan for when they're ready for that.
Yeah.
And now a word from the sponsors who make this podcast possible. Are you thinking about opening an orthodontic practice? I know, it's a big decision, but saving 25% on the ADEC equipment you need to get started, that's an easy one. Because ADEC has a special program called Smart Start, designed to help you launch your first practice. You get up to 25% off your ADEC orthodontic equipment and furniture. You also get complimentary services to help you run and grow your business. And my favorite part, access to the Smart Start pricing for 2 whole years after you open your doors. That gives you flexibility to add more chairs as your cash flow grows. It's pretty smart. As an orthodontist, you care about getting all the little details right, and ADEC really got it right with this program. So if starting off with a big savings on ADEC equipment sounds good to you, the ADEC Smart Start is definitely worth a closer look. Just follow the link in the show notes to learn more. Hey docs, let's talk about Smile Suite, because it's not just another scheduling system. It's a game changer in the world of new patient management. And as a proud Smile Suite partner, I've witnessed the incredible impact it has on practices of all sizes. Smile Suite means your new patient calls and web leads are expertly handled 7 days a week, even during nights and weekends. And they offer top-notch customizable presentation software and seamless post-consultation follow-up. It's like having a secret weapon for your practice's success. Curious? Dive into the revolution at GetSmileSuite.com. And don't forget to mention Hey Docs to unlock some extra goodies. Elevate your practice with Smile Suite, because every smile deserves a suite of excellence. So let's talk about mistakes that you see, especially with doctors who are, trying to establish credit worthiness, or, trying to do the right thing, but maybe it doesn't end up being the right thing. Let's talk a little bit about that.
Sure. So when we have a pre-qualification with a doctor, it's where they can log into our digital portal and begin to proceed through the application. And we very quickly see some of those initial hurdles that can be overcome. And those are the ones that often stop that application in its tracks, Jill. And one of the more important ones is just simply a credit score. A lot of things can impact that. We'd like to see a minimum credit score of 680 or better. So it's a real clear line in the sand. If it's less than that, again, we're humans. Our underwriters are humans. Let's have a conversation. Why is it? Was it a mistake or a fluke or something that happened last year that's going to be corrected now that you've resolved some debt? Is there a story behind that we can develop? So we need to do that first. So credit score is very important. The other mistake I see is a lot of folks becoming very aggressive with paying down student loan debt.
Yep.
And that's emotionally driven. I get it. But banks are not as concerned about your accumulative student loan debt as you are, because we approach it more mathematically. The emotion's not tied up in that. So if it cash flows and that practice can help make the payments on those student loans, then, which is typically the case, then we're okay with that. But I'll see people throwing hundreds of thousands of dollars at their student debt, and they have no liquidity as a result. And that same argument could be made with revolving debt, which is also known as credit card debt in some cases, or department store cards.
Yeah.
You have $100,000 in your checking account you're very proud of. and yet you have $30,000 in credit card debt. You have $70,000 liquid now.
Yep.
We're going to subtract credit card and revolving debt right from the top line of what you think you've saved. So that's another big mistake that we see. And just being clear that if you have a bankruptcy in your history, that's going to be a problem. Even if it's 2 years ago, let's have a story as to why that happened. And maybe there is a legitimate argument there, but keeping a clean history in your credit file is important.
Yeah, I love that. And I think, for any docs that are listening, if you've got questions, I mean, the best thing you can do is reach out ahead of time, have a conversation, talk through it. And I just said this to a doc this week. I'm like, it's like going to a therapist. I need you to just say it all. It's all protected, but say everything that needs to be said so that they can help you, kind of determine, maybe say, hey, let's get that gift from a parent, or I know you've got a lot in that savings account, but just go ahead and pay off that credit card before you fill out that loan application, and it won't flag anything. So sometimes just having that real conversation, not being afraid to talk about the skeletons in the closet, because sometimes the skeletons aren't really as bad as you may think they are. And you just need some coaching on what are the steps that need to happen. I've seen, in my, so many years of doing this, people who've had some really crazy things in their past and still gotten loans and still been fine and still been able to achieve their dreams. But we had to just be strategic and plan and think. And, it isn't all about, anybody that's listening. It's not about you doing this on your own. There are experts out there to help you who want to help you, get to your end result of being able to fund this project that you're looking to do.
Yeah. The most enjoyable phone calls I get are from folks that are in residency.
Mm-hmm.
Because I'm like, thank goodness you called me early. Like, let's talk about stuff now. Because I'll loan to you as soon as you get out with your certificate from residency.
Yeah.
You don't have to have employment experience. And so let's start talking like early about what's your vision? Where do you want to be? Who's on your team? What's this going to look like? And how do I prepare?
Mm-hmm.
It's the folks that call me too late or start making decisions without thinking through that are the ones facing the real challenges.
Yeah. Yeah. So before we finish up, I just had kind of a thought come to mind here. And I want to kind of circle back all the way to when we first started talking, and we were talking about purchasing practices. And I'm curious if you can talk just a little bit about, because I have had a lot of docs that are also talking to me about being a startup, but wanting to buy land and build from the ground up. And we didn't really talk about that. I mean, we were kind of talking as if we were buying an existing, building or pre-done space. Is there anything that's looking different right now from a financial perspective, or ways that you guys are looking at those opportunities differently than the other scenarios we talked about?
Really good question. Essentially, no. We're going to look at a ground up construction project the same as we would somebody that wants to purchase an existing building and do a startup. It's going to be looked at the same way. There's not additional risk. Some things that are different about it is ground up projects take longer.
Yeah, of course.
Because you're not just walking into a building and starting construction. You have to develop the ground and prep the site. And there's typically more expense in that and kind of getting that ready for your final construction. So ground up could be a little more expensive. However, in a lot of markets, it's becoming common where you can't find commercial real estate that's affordable or available in areas that you want to practice. And so maybe we consider getting outside into a more suburban or rural area where they do have land that's affordable. And I know that's where I'm going to be forever. Then we would approach that, Jill, with an SBA 7A loan to purchase the land and finance the entire project over a longer period of time, just like the building. And I have an example of that. Now I'm working on one where a dentist and a veterinarian friend both wanted to do a startup, their own practice, a separate vet practice from a dental practice, but they wanted to share in the ownership of the commercial real estate. So we did a ground up project with a dental office on one wing and a veterinary office on the other.
Mm-hmm.
And they own the building 50-50 ground up. And we've worked on this project for 3.5 years.
Yeah.
And they've got a
Yeah.
sign on the building now. So
Woohoo!
it takes time. Could they afford it? Sure. Of course they could. You wouldn't have loaned them the money.
Mm-hmm.
And so it just depends on how you're structuring this. In that case, we have this encompassing SBA loan for the real estate, and then they have their own individual loans for their practice as well. So you have to be able to get creative. But ground up construction, if you want to buy land, is very, very possible. And in some of these communities, Jill, you can find land for $500,000. It's large enough for you to build a 5,000 square foot facility. So maybe that becomes affordable.
Yeah. So here's something else I'm thinking about as you just said that. I've had some of my docs that just happened upon an opportunity early on to buy a plot of land that they knew for the future was going to be where, so they had an opportunity to kind of scoop it up. Now they've just been sitting on that. So they've got their practice, they've got the land. When you see situations like that, are you guys usually, kind of coming in if usually there's still a loan on the land, are you able to kind of roll that in to the loan, or does it work out sometimes where docs may have 3 different loans potentially going?
It's a good question. Is this doctor example we're talking about an established doctor that has a practice and then they found land that they're going to go build and move eventually? And
yeah. But let's just say they did not, at the time they were just like, I just want to hold the parcel.
Okay. So let's use an analogy. Let's take that same example and let's say that it's a homeowner that owns a home where it's mostly paid off. So just like this doctor probably owns their practice, more often than not, there's not a lot of debt there.
Right.
Over the years, they paid that off. So as a practice-based lender, what Provide's going to do is we're going to look at that doctor and recognize the equity in the practice. No differently than a bank would look at the homeowner who wants to build a pool in the backyard. And they say, well, you've got all this equity in your house. Let's do what we call a HELOC or a home equity line of credit against all that equity in your house. Right? We do the same thing for the practice. So we look at that practice and say, well, if they have the available equity in the practice, and say the land's $700,000, let's just create a separate new 10-year loan that's called an equity out loan against the practice to purchase the land. And we know they're now a partner to Provide. And we know that they may build in a year or so. That's fine. There's a lot that has to be done to prepare to build ground up. So now when that time comes, we evaluate what loan is best now for the remaining part of the project. Would it be, Jill, it could be a conventional solution at that point for an established doctor. It doesn't have to be an SBA loan. I've done conventional ground up projects.
Wow.
Quite a bit.
Yep.
But it has to be a really successful practice that can support the size of that project. But the answer is yes. We can use the power and equity in your practice now. It's the same way that I can use that equity to help a doctor with a down payment on a building conventionally. Same concept, Jill. Doctor sees a building, they want to buy it, they call you, and you say to them, hey, wait a minute. Remember, conventional loans, you have to put 20% down. Oh, I don't have that money. Well, wait a minute. Let's do a loan for the down payment against your practice and then do the remaining 80% as a regular real estate loan. Same concept. So what your customers need to remember, maybe the biggest takeaway if you're an established doctor, is use the power of your practice and leverage the equity to purchase real estate 100% or to purchase land or to help with whatever your dream is, right?
Yeah. Yeah, that's great. That's great. To me, it's so much fun just thinking outside the box a little bit, and definitely we have seen lending moving. There's still hard. We still have hard stops. So we've got bumpers, but I just have appreciated seeing just the evolution of how lending is moving, and it is still allowing doctors to do what they want to do with just a little bit more flexibility or more opportunities. We just have to be sometimes a little more creative and think about that. So that's great.
That's the right word, is being creative and having the conversations and realizing it's not
Mhm.
always just spreadsheets and being black and white. Fifth Third Bank is fully committed. I mean, we are willing to loan to any independent healthcare private practice owner with conventional or SBA solutions. And if you just slow down and kind of think through what is the borrower trying to accomplish, there's more often than not a solution there.
Yeah, yeah, that's great. Well, Steve, as you know, you and I could just talk and talk and talk with it. We both love this, but we've got to wrap this up here. So, if somebody wants to talk to you, we've got them thinking, maybe I just need to have a conversation. What's going to be the best way that they can get a hold of you, that they can connect, so that they can get those questions answered and just find out, is there an opportunity for them to pursue their dream?
Sure. Well, so if they, lose track of this video and don't know how to get a hold of me, you can always direct them, of course, your team. My name's in this video. It's Steve Steinbrunner, and it's steve.steinbrunner at getprovide.com
Yeah.
and 720-550-2567. Give me a call anytime you want. Happy to help. And you can also check the Provide website for Practice Marketplace and look for practices that might be available for sale. We have a nice clearinghouse there as well for folks that just want to see what's out there.
Yeah, that's great. Well, you know how I like to finish this up with a little speed round. Are you ready to jump right into the speed round?
I've forgotten all about the speed round. So you got me unprepared right now.
I love
scared.
it. Yeah, I'm not scared. I'm not scared of you, Jill. Okay, here we go. This will be easy. What is one business trend you think more people should be paying attention to right now?
Business trend?
Mhm.
Hmm. Well, what's interesting for me is I'm in the healthcare space. And so a business trend I'm seeing is the growth of kind of wellness focused businesses,
Mm.
med
Mhm.
spa, self care, stretch
Yeah.
labs. I'm seeing a lot more attention that people are giving to themselves. And in healthcare, private practices popping up that are owned by all kinds of folks that are kind of helping them in that wellness arena. So that's kind of cool
Yeah.
for what I'm dealing with.
Absolutely. Absolutely. All right, here's one more. What is the most unexpected lesson you've learned in your career?
Unexpected lesson. I think surround yourself with people you trust and let them do what they do really well. Like,
Mm.
I think when you're young, especially if you have some confidence, you think you can take on the world. And I realized a long time ago, whether it's somebody that you work for or somebody that you work alongside, like the trusted partners we work with, is understanding that there's people that are really, really good at what they do. Pick the right people to be professional with and let them go.
Yeah. Yeah, I love that. That's so true. All right, and the last one, I promise this will be an easy one. Well, I think it will be. If you had unlimited resources, what is one big idea you'd want to bring to life?
Unlimited resources?
Unlimited. Unlimited. You could just do anything. What would you want to do?
Oh, wow. I don't know. Well, I live in Colorado, so I like to do fun stuff like mountain biking and skiing and stuff like that. So if like I didn't have anything else, and I still like helping young folks with things like
Hmm.
start their business or practice. So I create this like Disney World in the mountains where you can have fun and it's a retreat and you can ski or snowboard and young entrepreneurs can come and share with each other on how to be successful.
Oh, I love that idea. Let's do that.
Do both.
I went in on that one.
Because we still get to coach and help, but
Yeah,
we also
yeah.
get to play. So it's
It's
one of those
best
deals where,
best of both worlds. I
I
love
know
those mountains.
I've been watching the Colbert questionnaire And so I thought they were going to ask me like, what's the best sandwich and stuff. I was prepared for those, not these really in-depth questions. So I was like, Reuben, I was going to come out with the Reuben has been a guarantee.
Oh, that's awesome. Well, I should make them easier, but it's just so much fun to hear what people have to say. So, well, Steve, again, thank you so much for being on Hey Docs again. Every time you come, you just drop us with a load of information. So thanks for spending the day with me.
It's my pleasure. Thanks for having me, Jill.
See ya.
Bye.